Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. This is The Talking Point. It is Monday morning, and it is March 13th. And the market is up as I do this call just before noon on Monday morning. Let's see what's going on. One is an expectation that the Fed is going to actually come out with an announcement that they are going to pause for the March 22nd meeting. They are right now at the in what's called the blackout period, where they typically do not speak out publicly before the week before the meeting. So the market is suggesting, when I say the market, commentary and so on, and betting that the Fed will just say, we're going to pause. We're going to see how this works. There are two ways the Fed could do this, by the way. One way is to say no rate hike, right? That's one. The other is that the quantitative tightening program, right, that is halted or there's a pause there. Or they could come out and say both. They're going to just pause on the QT, quantitative tightening, and also not a rate hike. So that is part of the optimism, if you want to call it that, in the market. Now, we thought that this week we'd be talking about nothing but the CPI report that will come out this week, or the PPI report that will come out this week. We thought that would be it, right? We'll talk about it. We'll decide whether or not the market thinks it'll be 25 basis points or 50 basis points for March 22nd. But right now, it is a different story. Last week on Friday with the payroll report, what was interesting is that the market was actually relieved that they saw the unemployment rate tick higher to 3.6%. We saw the day before the payroll report that the new cases for unemployment, initial unemployment claims ticked higher, which the market wanted to see because we know the Fed wants to see that. But we also saw in the actual report that wages were leveling off, and that is really important for the Fed. For those who haven't heard me go on and on about this, let me just say that when wages are high, companies try to push it off into higher prices so that input cost of wages doesn't fall on them, that the consumer, retail or business says, okay, I'll pay that. That's inflationary. So it was positive to see that wages are starting to level off. They're starting to ease. So that was a good thing. And in fact, many experts in the market in terms of what the Fed might do at the March 22nd announcement for the Fed meeting thought this gives the Fed a chance to stay with perhaps 25 basis points. Now, all that said, the futures market was actually looking at 50 basis points. Yes, and then, guess what? Along comes the issue with the Silicon Valley Bank. That is the second collapse of a bank since, I think it was 2008 when Washington Mutual fell. But the point here is, and the biggest question for the market is, are there more cracks in the financial system within the banks, especially the regional banks? That's the question. And the Fed is trying very hard, along with the overall members of the government, to quell any concern, because the biggest concern they have is contagion. Because contagion is spread by fear, panic, and you just say, I want out. I just don't want to keep my money in this bank. Even though what the government has said is that depositors, whether or not they are under $250,000 covered by insurance or above $250,000, will be able to have their money liquid, be able to take the money out if they want. The question is for folks, well, what about me? What about my bank? Are they going to do this for everybody if this happens? That's the kind of thinking that the government, including the Fed, wants to quell. They want to make sure that doesn't develop into yet another round of fear and panic, and that, again, is contagion. So, again, we'll probably hear something from the Fed. They're meeting, there's a board meeting, and there may be an announcement. If there's no announcement, I would think then that they're going to just be paying attention to see what happens over the course of the week, and at the same time to see what the CPI report and PPI report suggest in terms of inflation. Remember that these are reports that are for the month of February. Obviously, we're looking back. So this is going to be extremely interesting, and it goes back to the old expression that when the Fed raises rates, something breaks. I won't get into the details of the Silicon Valley Bank, what happened, but remember, they are dealing with tech, which has been under pressure, and they're dealing with emerging tech, which is especially been under pressure because it's hard for them to get financing now, and that's one of the difficulties. So again, you have that, and we'll see whether or not that actually is part of a deeper crack across especially the regional banks. I can tell you that the Fed's watching that because that's the goal. The goal is to restore confidence that this is not systemic. That's what I want to point out, that it's not systemic. So we'll hear more, of course, over the next couple of days and see how this works out. But in terms of, the actual data releases this week, these are secondary to what the Fed has to deal with and what the government has to deal with, making sure that contagion, fear, panic is stopped. We are going to get the National Federation of Independent Businesses tomorrow, and that's important because they are the backbone of our country in terms of hiring, the backbone of our country. So we want to hear what they have to say in that report. We are also going to have, obviously, the Consumer Price Index, and we all know what we're looking for there. Is it hot? Is it cold? Or is it just staying the same? And then we'll have retail sales, which of course is very important because all eyes are on the consumer. All eyes are on the consumer. Can we maintain the course of spending and help the economy? We represent 70% of our economy, and that's why how we spend is very important. And then we are going to also have the leading economic indicators, very important. That comes from the Conference Board. This is important because what we want to see is that bottoms, and as that bottoms, you want to see it level off and then start to see that it's moving higher. When news becomes less bad, that is when the market tends to pick up because they follow all of these indicators, and you want to see a leveling off of bad news and then a beginning to see a pickup. So that's going to be watched too. And then we're going to have the home builders report, their survey. It's interesting because guess what? Money has poured into the Treasury market out of fear. And we're seeing the yields come down. I know that this home builders report is not up to date as of the date, but there are those people who are saying, okay, I still have money. I've been waiting for mortgage rates to come down. The 10-year Treasury is down. The 2-year, which is focused on monetary policy, that is down also. And so the market is thinking, whoa, the Fed, even if they do not announce no rate hike for March, that the Fed is going to be finished much sooner than we thought even last week or the week before. The futures market is looking for an end of Fed tightening campaign coming about 5%, 5.25%, maybe in November, and then maybe towards the end of the year a rate cut or even 2 rate cuts, depending on whether or not conditions are such that we will be pushed into a recession sooner than we think. And then the Fed, of course, comes in and lowers rates. So this is a kind of a turn of events that is pushing us to think perhaps differently, and the Fed perhaps differently, and that's probably what they're discussing right now at their board meeting. And I think there will be an announcement before the Fed meeting. Again, if we don't have an announcement, I think it's that the Fed is sticking to its plan if they see inflation higher. But I would say they would not go to 50 basis points. It would be sticking to 25 basis points. The other aspect of this and of this week is how far are yields going to go? How low can yields go? The Treasury, the tech sector loves it. You see the NASDAQ outperforming the other sectors. But if, and this is a big if we see more systemic risk, it's going to be difficult for the market to remain in the green. The volatility index has edged higher. It's not screaming panic yet. It was the 26th, the last that I looked, but that's certainly up from where it had been sitting for so long, just under 20. And if it went above 20, it would stay at about 22. Panic is that you get up to 30 and 40 and maybe even 50. We're not there. In any case, it's going to be a very interesting week. And to repeat, I am looking at the 2-year Treasury yield and the 10-year to see how much money is coming into the Treasury market out of fear, and that's what it is. I want risk off. All I want is risk off. I'm going into the Treasury market, and it's money coming in from overseas too. It's not just American money coming in. A lot for the market to digest this week. Please don't hesitate to get in touch. We're here, and we've had a lot of questions from advisors, and as advisors have questions from your clients, we're here to help out. Thank you so very much. Have a good week.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.